turn to everybody's other favorite topic, taxes. Tax planning this year may be especially tricky because of legislative changes and the fiscal cliff, which we talked about 3 weeks ago on the program with Jim Russell. In this morning's U.S. Bank Economic 360, U.S. Bank investment analyst Jim Russell is joined by Scott Mann, U.S. Bank's Senior Vice President for Business Succession and Family Wealth Planning, to shed some light on what we might expect. Jim and Scott?
Brian, thank you. Good morning, everybody. Today we are privileged to have Scott Mann, one of our senior tax planning and tax experts at U.S. Bank, with us on the show today. Scott plays a local, regional, and national role with individuals and business owners on a variety of tax planning and business succession issues. So, Scott, thank you for lending your expertise with us today. You know, we're hearing a lot more, and the drumbeat's getting a lot louder about some of these significant tax changes that are on store for 2013. What should we expect?
Well, Jim, as you may know, there's a whole slew of tax cuts that are expiring at the end of 2012. Let's go through the list. All the tax cuts that are known as the Bush tax cuts, which came into play in 2001 and 2003, all those expire. So that includes marginal tax relief for everybody. It includes a child tax credit. It includes lower dividend rates, lower capital gains rates. All of those go away at the end of the year. In addition, there were some smaller tax cuts passed under President Obama in 2009. Those expire. There are business incentive credits that expire. The 2% payroll tax holiday expires at the end of the year, as well as some alternative minimum tax relief. And finally, the new health care tax, which applies to high-income folks, that kicks in for the first time in 2013. Of course, we'll see what the Supreme Court has to say about that here in June, but in totality, there's a lot of tax increases coming down the pike.
Yeah, Scott, there's a lot there. So, you know, what should our viewers be thinking about in terms of 2012 tax planning to maybe mitigate some of those impacts of the 2013 legislation?
Right. So anytime you're in an environment when you expect higher tax rates in the future, the general advice is, well, can we accelerate income into the current year at what we think will be lower rates? So how might you do that? Well, number one, your bailiwick, Jim, investments. You might look at your own personal stock portfolio and say, if I have some highly appreciated stock positions there, maybe I want to sell some of those this year and lock in that lower 15% capital gains rate. Similarly, if I own a business or a piece of commercial real estate and I'm considering selling that, same thing. Maybe I sell it this year instead of next year to lock in the lower rate. For folks that have stock options through their jobs, same thing. If they're in the money, maybe they can exercise some of that this year and lock in lower rates. On the business side, there are, as I said, there are some business tax incentives. If businesses are considering capital purchases, do that this year because you can lock in the benefits of those credits.
Great point. You know, I think you would agree with me that the November election will have a significant impact on tax thought, tax legislation in general. What's your sense on where tax legislation is headed on a post-election basis? You
know, of course, a lot of that depends on where we end up on the election. But I think regardless of who controls the White House and Congress, there's a couple main themes that are flowing through now, I think, from both parties. Number one, there's a growing sense that in order for the United States to be more globally competitive, we need a lower corporate tax rate. Right now, we're at 35%. It's one of the higher corporate tax rates across the globe. So to be more globally competitive, there's some pressure to bring that down. The second theme is the offshoot of that is if corporate tax rates are going down, it's probable that individual tax rates are probably going to go up to help pay for that. So whether that takes the form of higher individual rates or maybe limiting some popular deductions like mortgage interest deduction, charitable deduction, I would look for things like that.
Okay. Hey, Scott, great. Thanks very much for your expertise. Great stuff.